If you have ever felt that your money disappears faster than it should, I want you to understand that this is not just a feeling, it is a system. And the same system that quietly weakens your paycheck can, if you understand it, strengthen your investments. Time works against the person who only earns wages and spends dollars. But time works for the person who consistently owns assets. That distinction is small at the beginning and enormous at the end. This is why a habit as modest as investing $35 a week can become much more powerful than most people believe. The amount looks too small to matter. It does not feel dramatic, it does not feel like the kind of action that changes a life. But compounding does not require drama. It requires time, consistency, and ownership. When people think about wealth, they usually look for something large, a large income, a large inheritance, a large investment, a large opportunity. That is natural because the human brain is attracted to what is visible and immediate. But most financial freedom is not built by one large action. It is built by a small action repeated through an environment that rewards repetition. That is the principle. And once you see the principle, the $35 a week becomes much more interesting. Most people hesitate with weekly investing because the number feels too small. They think, what is $5 a day really going to do? What can $35 a week really become? How can a small weekly habit compete with bills, inflation, debt, and a full-time job? That is the wrong question. The better question is this: what happens when a small amount enters the compounding machine every week for decades, while inflation keeps weakening cash, wages grow slowly, and the market continues to recover from fear after fear? That is where the system becomes visible. Start with the pressure people feel in daily life. Food prices moved sharply higher over the last several years. The $20 of groceries that used to feel ordinary no longer buys the same basket from 2020 through 2025. Food inflation compounded in a way people could feel each time they walked through the store. A grocery bill does not need a lecture. It teaches you directly. Borrowing also became heavier. Interest rates rose from near zero to levels that made mortgages, car loans, credit cards, and other debts more painful. A household that was already stretched suddenly had less room to breathe. At the same time, wage growth did not fully close the gap. A paycheck can rise by 3% or 4% and still feel like it is falling behind. If the cost of food, housing, insurance, transportation, and interest costs moved faster in the years before it. This is what I mean when I say time works against the paycheck. A paycheck is paid in dollars. If the dollars buy less each year, then standing still is actually moving backward. That is why people feel exhausted even when they are working hard. The labor is real. The discipline is real. But the system keeps raising the cost of maintaining the same life. Now look at the other side of the system. The stock market has gone through crashes again and again. The Great Depression, the dot-com collapse, the financial crisis, the COVID crash, the inflation-driven decline. Every one of these events felt frightening in real time. People always believed in the moment that this one was different, that this time the system would not recover, that this time waiting on the sidelines was safer. And yet the long-term trend kept moving upward. That does not mean markets only go up, they do not. It means the system of productive assets, reinvested earnings, innovation, inflation. And ownership has historically rewarded the patient person who kept buying through the noise. Long-term market return data has often put broad market returns around 10 to 11% per year when dividends are included, though no year is guaranteed and no investor should expect a straight line. But over long periods, the difference between a paycheck growing at 3% or 4% and assets compounding at higher historical rates becomes enormous. This is the core idea. Your paycheck is tied to your labor. Your investments are tied to ownership. Labor is linear. Ownership compounds. That is why weekly investing works. You do not need to predict inflation. You do not need to call the exact bottom. You do not need to know which headline will matter tomorrow. You do not need to guess when the next crash will happen. You build a system where money goes in every week. If the market falls, you buy at lower prices. If the market rises, you already own assets that participate. If inflation keeps eating cash, your assets have a chance to grow faster than the currency loses purchasing power. A small weekly deposit becomes an automatic response to an uncertain world. That is powerful because the world is always uncertain. Most people wait for certainty before they begin. That is one reason they never begin. Certainty almost never arrives at the right time. When markets are down, people are afraid. When markets are up, people think they missed it. When headlines are bad, people want to wait. When headlines are good, prices are often already higher. Weekly investing removes the need to be emotionally brilliant. It asks only that you be consistent. That is why the amount matters less in the beginning than the habit. A person investing $35 a week may not look impressive in year one, but the system is being built, and systems create results that isolated actions do not. Let us look at how the snowball starts. Imagine someone investing $20 every week. That is $1,040 per year. For many people, that amount feels small enough to dismiss. They might spend it without noticing: a few meals out, a few subscriptions, a few impulse purchases. It disappears because it never enters a system. But if it is invested, something changes in the first year. The account may not move much. The contribution is the main force. Market growth and dividends may add a little, but nothing feels dramatic. This is the stage where most people quit. They say, "This is too slow." They say, "I do not see the point." They say, "I need something bigger." But they are looking at the wrong part of the curve. The beginning of compounding is supposed to look boring by year 3. The total contributions might be $3,120. With market growth and reinvested dividends, the balance may be higher than the amount contributed. Not life-changing yet. But now the portfolio is no longer only the product of deposits. The assets are beginning to produce additional growth. By year 5, the total contributions might be $5,200. The account may be closer to $6,850 depending on performance. Now the snowball has more mass. Each weekly deposit lands on a larger foundation. Dividends buy more shares produce more dividends. The loop begins to reinforce itself. The first 5 years do not look explosive. They build the base that makes the later years explosive. This is one of the most important lessons in finance. The beginning of the process feels like nothing is happening because most of the power is still under the surface. That is why people who understand compounding have an advantage over people who only understand speed. Speed looks exciting, compounding looks slow until it becomes overwhelming. The mindset is as important as the math. Most people do not fail at weekly investing because the arithmetic is too complicated. They fail because the early results do not emotionally reward them. You invest $20 or $35, the balance moves a little. Then the market drops. Then the balance looks smaller than it did last week. Your brain says this is not working. That is linear thinking. Linear thinking expects progress to appear in a straight line. But markets do not move in straight lines. Compounding does not reveal itself evenly. It builds in curves. It is quiet for a long time. Then suddenly the numbers begin to move faster than your contributions. The real shift happens when you stop asking, "Is this growing fast enough?" You ask, "Did I invest this week?" That is the controllable variable. You cannot control inflation. You cannot control interest rates. You cannot control the next recession. You cannot control the next market correction. You cannot control the exact return in any given year. You can control the system. Did money go in this week? Did I stay invested? Did I reinvest the dividends? Did I avoid panic? Did I allow the process to continue? That is the better scorecard. And over time, that scorecard can produce something bigger than a paycheck. Not because you outsmarted the market, because you stopped interrupting the process. Now, once the habit is understood, the next question is what to own. This is where many people complicate the problem too much. They want the perfect pick. They want the next stock that will triple. They want certainty. They want a shortcut. A better approach is to look for qualities, diversification, broad exposure, a record of real performance, dividend growth, low fees. These are not exciting words, but they matter. Diversification means you are not depending on one company. If one business fails, the whole plan does not fail. A broad fund can own hundreds or thousands of companies. That is a structural advantage because the investor is no longer betting the entire future on one management team, one product, or one cycle. Broad exposure is related but different. Diversification is about owning many companies. Exposure is about what kinds of companies you own. Large companies, mid-sized companies, growth companies, dividend companies, sustainable companies, different sectors, different styles. Markets rotate. Some years large companies lead. Some years mid-caps do well. Some years growth dominates. Some years defensive income matters more. A portfolio with multiple exposures does not need to know which area will lead next. Real historical performance matters because you want evidence, not hype. You want funds backed by companies that have grown earnings, paid dividends, strengthened fundamentals, or captured broad market growth over time. Dividend growth matters because dividends can create a compounding loop. When dividends are reinvested, they buy more shares. Those shares produce more dividends. If the underlying companies raise dividends over time, the income engine can strengthen year after year. Low fees matter because the fee you do not pay stays inside the compounding machine. Over 1 year, a small fee may not look important. Over 30 years, fees can become a quiet tax on wealth. This is why a simple fund portfolio can work so well. It does not need to be clever every week. It needs to be durable for decades. Now let us look at the Fidelity funds described in this framework. The first is FRADROX, the Fidelity Zero Total Market Index Fund. This is the core. It is a broad U.S. total market fund. It gives exposure to large cap, mid cap, and small cap companies. Across major sectors, its role is simple: own the U.S. market broadly with zero management fees. The zero fee structure matters because the investor keeps more of the return working inside the portfolio. The fund is not trying to be exotic. It is not trying to make a dramatic prediction. It is trying to capture the broad productive base of the American stock market. In the original structure, it is described with a yield around 1.04%, dividend growth of 7.55%, and annual price appreciation of 13.5%. The exact numbers can change over time, but the role is clear. FRADROX is the foundation. The second fund is FSMDX, the Fidelity Mid-Cap Index Fund. This fund focuses on mid-sized companies. Mid-caps are interesting because they sit between large companies and small companies. They may already have real business models, revenue, and stability, but still have more room to grow than the largest companies. They can bring expansion potential into the portfolio. FSMDX is described as holding around 300 companies across sectors such as technology, industrials, consumer businesses, and finance. It carries more growth-oriented risk than a purely defensive fund, but that is why it can add value in the right structure in the original numbers. It had a yield around 2.42%, dividend growth around 17.21%, and annual appreciation around 7.4%. The exact future is unknowable, but the purpose is understandable. It adds the middle layer of the market, companies still climbing. The third fund is FITLEX, the Fidelity U.S. Sustainability Index Fund. This fund gives the portfolio a modern growth tilt. It focuses on companies screened for sustainability characteristics, often including major companies in technology, healthcare, communication services, and other future-oriented sectors. The reason this matters is not that any screening method is perfect. It is that a portfolio can benefit from exposure to companies that are shaping long-term economic change. The original structure described FITLEX with a yield around 1.14%, dividend growth around 13.74%, and annual appreciation around 13.06%. Again, those figures are not guarantees. But the role is clear. FITLEX adds future-facing exposure and long-term resilience. The fourth fund is FGRX, the Fidelity Growth and Income Portfolio. This fund brings balance. It invests largely in high-quality, large-cap companies with stable earnings and a mix of dividend income and growth. Its purpose is to provide both income and appreciation, not one at the expense of the other. That matters because a portfolio should not be built only for a perfect environment. It should be built for changing environments. Growth helps when markets are expanding. Income helps when markets cool. Quality helps across cycles. In the original numbers, FGRX was described with a yield around 3.13%, dividend growth around 19.68%, and annual appreciation around 8.17%. Its role is to lift both sides of the portfolio, income and growth. The fifth fund is FDGFX, the Fidelity Dividend Growth Fund. This is the income stabilizer. It focuses on companies with long histories of raising dividends and strong financial fundamentals. It is not meant to be the fastest moving part of the portfolio. It is meant to strengthen the income engine and support compounding through dividend growth. That role matters because not every part of a portfolio should behave the same way. Some assets should pursue growth, some should provide balance, some should provide income consistency. FDGFX was described with a yield around 3.2%, dividend growth around 18.03%, and annual appreciation around 2.78%. Its job is not to race, its job is to reinforce together. These five funds create a simple system: total market exposure, mid-cap growth, sustainability, and future-facing companies, growth and income. Dividend growth. This is not the only possible portfolio. It is not a promise. It is not a magic formula, but it is a good example of how small weekly contributions can be placed into a structure with diversification, income, growth, and low-cost compounding. Now let us look at the average numbers in the example. If the five funds are equally weighted, then the average dividend yield is found by adding the yields and dividing by 5. FRADROX at 1.04%, FSMDX at 2.42%, FITLEX at 1.14%, FGRX at 3.13%, FDGFX at 3.2%. Add them together and you get 10.93%. Divide by 5 and the simple average portfolio dividend yield becomes about 2.19%. That means, in this example, the portfolio begins with an income component. It is not extremely high yield, but it is not zero. And because dividends can be reinvested, the income helps acquire more ownership. Using the same simple average method, the portfolio shows an average dividend growth rate of about 15.24% and average annual share price appreciation of about 8.98%. Those are historical or example-based assumptions, not guaranteed future results. But they show the logic. The portfolio is designed to grow in value and grow in income. That combination is important because a rising portfolio balance alone is useful, but rising income creates another layer of compounding. Now let us apply the habit. Imagine Josh contributes $5 per Dalton Y, that is $35 per week, across 5 funds. That is like putting $1 per Dalton Y into each fund. It sounds almost too small to matter, but the smallness is part of the point. If the habit is small enough to sustain, then the system can operate for decades. By the end of year 1, Josh contributes about $1,825. That is not life-changing, it is a foundation. By year 10, with reinvested dividends and assumed market growth, the portfolio in the example reaches around $32,000. Now something is visible. The habit has created an asset base by year 20. Josh has contributed about $36,500 total, but the portfolio may be around $160,000 under the example assumptions. Now the difference between contributions and portfolio value becomes much larger. The snowball is no longer small, the assets are doing more of the work, and the portfolio may be generating nearly $9,000 per year in dividends under the example S assumptions. By year 30, the projection becomes much more dramatic. Josh's total out-of-pocket contributions over 30 years are about $54,750, but the portfolio is projected to reach about $942,000. That means most of the wealth did not come directly from Josh's deposits. The deposits were the seed, the compounding machine created the forest. If the portfolio generates about $98,000 per year in dividends at that stage, that is roughly $8,000 per month in income. That is the idea behind the title. A $35 weekly habit, given enough time and compounded in an asset portfolio, can theoretically produce income that rivals or exceeds many full-time jobs. But the important lesson is not that everyone will get exactly that number. The important lesson is that the majority of the result comes from time and compounding, not from the size of the initial contribution. That is what people underestimate. They see $35, they do not see 30 years. They see a tiny action, they do not see a system, they see today as sacrifice, they do not see tomorrow. Ownership, this is why people fail to start. They judge a long-term curve by the first inch of the line. That is a mistake. The first inch is supposed to look flat. Now I want to talk about the relationship between the paycheck and the portfolio. A paycheck comes from labor, you work and money arrives. Then the money is spent. If you want more money, you usually need more hours, more skill, more responsibility, or more stress. There is nothing wrong with a paycheck, it is necessary for most people. But a paycheck has a limit because human time has a limit. A portfolio is different. Once assets are owned, they can work while you sleep. Dividends can arrive without additional labor. Earnings can be retained and reinvested by the companies. Share prices can rise as businesses grow. The market can recover even when you are not doing anything. That does not mean there is no risk. There is always risk, but the mechanism is different. Labor produces income once, capital can produce and reproduce returns. That is the difference between being paid for effort and being paid for ownership. The purpose of weekly investing is to slowly move more of your financial life from effort to ownership. At first, the paycheck is everything. Then the portfolio becomes meaningful. Then the portfolio begins producing returns that are larger than your weekly contributions. Then the portfolio begins producing returns that are larger than a monthly bill. Eventually, if the process continues long enough, the portfolio can produce income that competes with work itself. That is the transition, not sudden, not dramatic, but structural. Now, I want to be careful here. This does not mean you should invest money you cannot afford to invest. It does not mean you should ignore debt, emergency funds, or basic cash flow. A good investment system sits on top of a stable base. If someone has high-interest credit card debt, that debt may need priority. If someone has no emergency fund, a cash buffer matters. If someone is unable to pay bills, investing is not the first problem. But for someone who can free even $35 per week, the habit can become extremely valuable. The first step is not to be rich. The first step is to create a repeatable surplus. That surplus, no matter how small, is the seed of ownership, and the best surplus is not the one you promise emotionally, it is the one you can execute consistently. This is why automation helps. If the money moves automatically every week, The habit no longer depends on motivation. Motivation comes and goes. Systems persist. A weekly automatic contribution is a way of telling your future self, this process will continue whether I feel excited or not. That matters because many investors only act when emotions are high. They buy when they are excited, they stop when they are afraid, they sell when they are discouraged. That behavior destroys compounding. Weekly investing reverses the behavior. It keeps buying when emotions are noisy. It creates a rhythm that is independent of headlines. If the market drops, the same $35 buys more shares. If the market rises, the prior shares are already participating. That is dollar cost averaging. It is not perfect. It does not guarantee the highest return in every scenario. But it is powerful because it removes the need for perfect timing. Most people are not good at timing. Institutions struggle with timing. Professionals struggle with timing. Retail investors often do even worse because they are making decisions under emotion and incomplete information. So do not build a plan that requires you to be a perfect market timer. Build a plan that works because you are not one. That is a principle. The other principle is reinvestment. Dividends should not be treated as spending money in the early years if the goal is growth. They should be reinvested. Reinvestment is what strengthens the loop. A dividend buys more shares. Those shares create more dividends. More dividends buy more shares. The loop is quiet at first, then it becomes meaningful, then it becomes powerful. The same is true of capital gains. If the portfolio grows and you interrupt it repeatedly, you reduce the base. If you leave it alone, the base grows larger. Compounding needs two things: growth and non-interruption. Many people supply the growth opportunity but keep interrupting the process. They sell because of fear. They withdraw for consumption. They stop investing because the balance feels small. They switch strategies constantly. They chase whatever worked last year. Each interruption resets part of the machine. The investor who keeps the machine running often beats the person who keeps looking for a better machine. Now let us think about inflation again. Inflation is destructive when your money sits idle. If the cost of living rises and your cash does not grow, your purchasing power falls. But productive assets can respond differently. Companies can raise prices, earnings can grow, dividends can rise, asset values can increase over long periods. This does not happen perfectly. Inflation can hurt markets in the short term. Higher rates can pressure valuations. Recessions can reduce earnings. But over long periods, ownership of productive assets has historically been one of the ways people defend against the weakening of currency. So the weekly investment is not only about getting rich, it is about not allowing inflation to quietly make you poor. That is a defensive and offensive move at the same time. Defensive because you are protecting purchasing power. Offensive because you are building ownership. Now, a $35 weekly habit also changes identity. At first, a person thinks, I am someone who works and spends. Then they become someone who invests. That identity matters. When you own assets, you pay attention differently. You begin to notice markets. You begin to understand dividends. You begin to think in decades instead of days. You begin to see inflation not only as a complaint, but as a force to plan around. This is how financial behavior changes. People do not become better investors only by receiving information. They become better investors by participating in a system that makes the information relevant. Once your money is invested, the lessons have consequences that creates focus, and focus creates learning. Now, I want to keep the structure of the example clear. The Fidelity portfolio uses equal weighting in the simple calculation. That means each fund is treated as 20% of the portfolio. That is simple and easy to understand. But in real life, an investor could adjust weights: more total market, less mid-cap, more dividend growth, more growth and income, different allocations for risk tolerance. The point of the example is not that equal weighting is the only correct structure. The point is that a diversified low-cost income and growth-oriented portfolio can turn small contributions into a meaningful long-term asset base. You should not blindly copy any portfolio because a video mentions it. The right allocation depends on your age, risk tolerance, goals, tax situation, time horizon, and broader financial picture. But the lesson is still strong. The structure matters less than the consistency. As long as the structure is reasonable, diversified, low cost, and durable, bad investments cannot be saved by consistency. But good enough investments held consistently can do extraordinary things over time. That is the balanced view. Now let us examine the projection honestly. When a projection says $35 per week could become close to $942,000 and produce about $8,000 per month in dividends, that depends on assumptions. It depends on returns. It depends on dividend growth. It depends on reinvestment. It depends on fees. It depends on taxes. It depends on no major interruptions. It depends on the future being favorable enough for the compounding curve to continue. No one can guarantee that. But projections are still useful when they teach the relationship between inputs, time, and compounding. A projection is not a promise. It is a map of what can happen if certain conditions are met. The intelligent investor does not confuse the map with certainty. The intelligent investor uses the map to understand the process. And the process is this: small weekly contributions create shares. Shares produce dividends and appreciation. Dividends are reinvested. Reinvestment buys more shares. More shares produce more income. Time magnifies the loop. That is the engine. If the actual number is lower than the projection, the habit can still be valuable. If the actual number is higher, the habit becomes even more powerful. The point is not to obsess over the exact ending value. The point is to build the engine. Because without the habit, the ending value is zero. Now, let me bring this back to the lived reality of most people. They are not failing because they do not want to be wealthy. They are failing because the modern financial environment constantly pulls money away before it can become capital. Food costs more, housing costs more, debt costs more, subscriptions multiply, cars become more expensive, insurance rises, wages lag, and every month, the paycheck feels like it has already been claimed before it arrives. That is the pressure. The response is not to wait until life becomes easy. It may not become easy. The response is to carve out a small piece of the cash flow and put it into a system that works in your favor. Even $5 per Dalton Y. Even $35 per week. The amount is modest, but the act is profound because it changes the direction of the money. Money that would disappear becomes money that owns. Money that would be consumed becomes money that compounds. Money that would be forgotten becomes money that can later produce income. That is the shift. And if you repeat that shift long enough, it can change the arc of your financial life. Now, why weekly rather than one? Time deposits. A one-time deposit is useful if you have the money, but many people do not have large lump sums. They live from paycheck to paycheck or close to it. Waiting for a large amount can become an excuse to do nothing. Weekly investing fits the rhythm of real life. It turns wealth building into a routine rather than an event. It allows the person to participate in different market prices throughout the year. It reduces the emotional pressure of deciding whether now is the perfect time. It makes investing normal. That is important. What becomes normal becomes sustainable, and what is sustainable can compound. A person who invests once and then stops may feel good for a moment. A person who invests every week changes the structure of their life. That is why I like the weekly habit. It is not glamorous, it is durable. Now, if someone starts late, the principle still applies. The numbers change, but the logic remains. A person starting at 20 has more time. A person starting at 40 has less time, but may have more income. A person starting at 50 may need larger contributions and a more careful plan. The best time to start is early. The second best time is when you realize the system. Do not use lost time as a reason to lose more time. The compounding curve rewards earlier action, but it still rewards action. You cannot go back and invest last year. You can decide whether you invest this week. That is the controllable variable again. Now, as the account grows, the emotional challenge changes. At first, the challenge is believing the small amount matters later. The challenge is not interrupting a larger balance. When the account reaches $50,000, a market decline can show a paper loss that feels large. When the account reaches $200,000, normal volatility can move the balance by thousands of dollars in a week. When the account reaches $900,000, a 10% correction is a $90,000 decline. That is why mindset must grow with the portfolio. The numbers become larger. But the principle remains the same. Markets fluctuate. Ownership compounds over time. A long-term system must survive short-term discomfort. The person who cannot tolerate volatility may never capture the full reward of ownership. This does not mean taking unlimited risk. It means understanding the risk you own and making sure the portfolio fits your ability to stay invested. A diversified fund portfolio can help because it spreads risk across many companies and sectors, but it does not eliminate market risk. It will still fall during market declines. It will still test your discipline. That is why education matters. When you understand why you own something, you are less likely to abandon it when the price moves. Conviction should come from structure, not hype. That is why the fund criteria matter: diversification, broad exposure, historical performance, dividend growth, low fees. Those are structural reasons to own funds for long periods. Not because they were exciting this week, because they can fit inside a long-term compounding system. Now let me summarize the system in plain language. Inflation weakens idle cash. Wages often grow slowly relative to the cost pressures. People feel markets are volatile, but broad ownership has historically recovered and grown over long periods. Weekly investing removes the need for perfect timing. Small contributions build the base. Reinvested dividends strengthen the loop. Low-cost funds keep more of the return working. Diversification reduces single company risk. Time turns modest contributions into meaningful assets. The early years look boring. The later years reveal the power. That is the story. And this is why the $35 matters. Not because $35 is large, because $35 repeated weekly for decades is not $35 anymore. It is behavior, it is discipline, it is ownership, it is the start of a compounding process. A person who says, I will start when I have more money, may never start because life keeps finding uses for money. A person who starts with a small amount builds the muscle. Then, when income rises, the contribution can rise. When debt is paid off, the contribution can rise. When bonuses come, some can be invested. When spending is reduced, the difference can be invested. The initial habit creates the channel. More money can flow through that channel later. This is how wealth building becomes easier over time. At first, your contributions do most of the work. Later, the portfolio begins doing more of the work. Eventually, the portfolio can do more work than you do in contributions. That is the point where people begin to understand what financial freedom really means. It does not mean never working. It means your money has become a second worker, and later perhaps a better worker than you. One that does not sleep, one that does not need motivation, one that continues compounding if you leave it alone. That is the power of investing. Now, I would not tell anyone that one fund list is the only path. There are many ways to build a low-cost diversified portfolio. Fidelity funds are one example, Vanguard funds are another, Schwab funds are another. Broad index funds can be built in different ways. The specific fund names matter less than the principles. Own productive assets, keep costs low, diversify, reinvest, contribute consistently, think long-term, avoid emotional interruptions. Those principles can work across many platforms. But the Fidelity example is useful because it shows how a small weekly deposit can be divided across a portfolio with a clear purpose. FATS for broad U.S. market ownership, FSMDX for mid-cap exposure, FITLEX for sustainability-oriented future-facing companies, FGRX for growth and income, FDGFX for dividend growth and income stabilization. Together, they form an example of a diversified structure, and the structure gives the habit somewhere to go. A habit without a structure is just intention. A structure without a habit is just theory. When the habit and structure meet, compounding begins. That is what I want you to see. If you are waiting for the perfect moment, you may be thinking about money in the wrong way. The perfect moment is usually visible only in hindsight. The real advantage is building a system that does not need the perfect moment. That is what weekly investing does. It makes uncertainty part of the process instead of an obstacle to the process. If prices fall, you buy. If prices rise, you buy. If headlines are frightening, you buy. If headlines are optimistic, you buy. You do not need to know which week is best. You only need to keep the weekly system alive over 30 years. That is the edge. Not genius, not prediction, not luck. A durable system. And I would choose a durable system over emotional brilliance almost every time. Because emotional brilliance usually fails under pressure, a system keeps going. Now, I want to be honest about the hardest part. The hardest part is not choosing the funds. The hardest part is continuing when nothing impressive is happening. In year one, the account may feel small. In year two, a market decline may make it look like your work disappeared. In year three, you may feel tempted to stop because life gets expensive. In year five, you may still not feel wealthy, but if you keep going, the base grows. And once the base grows, market returns begin to matter more than contributions. That is the turning point. At first, the weekly contribution is the engine. Later, the portfolio becomes the engine. You have to live long enough inside the boring part to reach the exciting part. Most people do not. That is why the boring part is where the advantage is. Anyone can get excited when the balance is large. The rare person acts when the balance is small. That is the discipline. And that discipline can create the difference between a life where money keeps disappearing and a life where money begins returning. So if $35 a week is possible, do not dismiss it, respect it, put it into a system, automate it if you can. Reinvest the dividends, ignore the noise, review the portfolio periodically, but do not constantly disturb it. Increase the contribution when life allows. Keep the fees low, keep the strategy simple enough to follow. And remember that the goal is not to feel rich this month. The goal is to build a machine that can one day produce income without requiring your daily labor. That is the real shift from paycheck dependence to asset income, from spending everything to owning something, from time working against you to time working for you. A $35 weekly habit will not feel like a revolution in the first week, but in a compounding system, the first week is not the point. The point is what that first week becomes when it is repeated long enough. That is how small money becomes serious money. That is how ordinary discipline becomes financial freedom. And that is how time, which once worked against your paycheck, begins working for your investments.